Some trends are so influential they can move entire sectors of the market. Take demographics. Our aging population could impact the performance of all healthcare companies, but selecting precisely which companies will benefit can be challenging. The Healthcare Sector Spider ETF offers the diversification of the entire healthcare sector while minimizing your single stock exposure. The Healthcare Sector Spider, the next chapter in investing. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
All right, coming up on today's program, strategies for reducing 2018 taxes, a couple of late year moves that you can make to do that. Also coming up, we're going to get into your emails as well as phone calls. If you'd like to join us, we're here, 844-305-7800. You want to talk about a particular stock, mutual fund, ETF. I've also got things I need to share with you on our Twitter feed, @Index Show. A lot to get into. Let's begin with where we're at in terms of market prices. So far this year, total U.S. stock market is ahead by almost 5%. Ticker symbol SCHB follows that area. So total U.S. stock market still hanging on in positive territory. We made it through October. It was a rough month, but November so far has started out pretty positive. Total U.S. bond market, ticker symbol BND, down about 2.5%. So stocks have been winning over their counterparts' bonds in 2018. A large part of that is obviously due to the fact that interest rates have been up over the past several quarters. And, of course, when interest rates rise, what happens to bond prices? Do we know, class? Bond prices fall, especially long-term U.S. bonds and long-term U.S. treasuries, which have taken a beating. So that's what's been going on there. Now, I wanted to mention also, coming up a little bit later, my program guest, Silvia Jablonski at Direction Investments, will be joining us. We're going to be talking exactly about this particular investing trend, or you might call it a theme. Actually, it's more of a trend than a theme, rising interest rates. And we're going to talk about exactly what this has meant from a trading perspective and how you can capitalize on this trend. And we're going to give you some ETF ticker symbols that profit from this. So stay tuned for that. Silvia Jablonski at Direction Investments coming up a little bit later. Now, taking a look at some other key areas, emerging market stocks are down about 8.5% this year. Strike that. That's international stocks down about 8.5%. Emerging market stocks are down almost 15%. The difference, in case you're wondering, between international stocks and emerging market stocks typically refers to equities from countries that are still in the process of becoming developed economies. So they're not fully industrialized. We're talking about places like Indonesia, places like Mexico, as well as Russia and China, Brazil. I mean, these are some of the bigger emerging market countries, India. So that's the difference. International stocks typically refer to developed nations. You might say G7 nations, places like Japan and the United Kingdom, Australia, Canada, the U.S. So that's just the difference. Of course, the U.S. would not be an international stock if you're based in the U.S. If you're not based in the U.S., it would be international. So these are some of the things that you need to understand to help you comprehend the differences. Now, in terms of other major asset classes, there's two other final areas that I need to mention. Global real estate, ticker symbol REET, is ahead by 0.25% this year and just barely hanging on to gains. And then commodities as a group, ticker symbol USCI, are down about 5.5%. That area, as of late, has really struggled, particularly energy commodities like oil have really been in the dumper. Oil is in a bear market, and we thought we were going to get a recovery in oil earlier in the year. Well, that really, over the past week or two, has really not come to fruition. So oil is really in the dumper, and that's been a great trade for you oil bears and you energy bears. I'm going to share with you a ETF that capitalizes on this trend, and that is designed to go up in value when energy stocks and oil go down. So stay tuned for that. 844-305-7800 is the number. We're here. If there's any stocks, mutual funds, ETFs, or investment trends or strategies you'd like to discuss, we can do that. Again, 844-305-7800. What emotion is driving the stock market right now? Well, the fear and greed index is still in extreme fear territory. It's at 18. Last week it was at 11. 0 is extreme fear. So we were at 11. Now we're at 18. A modest improvement from last week. Extreme greed, by the way, which is the opposite of extreme fear, is at 100. Remember, extreme fear is 0. Extreme greed is 100. Right now we're at 18. So this is kind of a comprehensive understanding of what is the sentiment, what is the mood of the market. So still very fearful. We see certain indicators like put and call options. Still, that's called the put call ratio, 5-day average, still at extreme fear levels. Stock price strength still at fearful levels. We got the number of stocks hitting 52-week lows, exceeding the number of stocks hitting highs. That is at fearful levels. We've also got other indicators like the McClellan Volume Summation Index, which basically measures stock market breadth. And during the last month, it's showing basically the advancing and declining volume on the NYSE. During the last month, approximately 1.5% more of each day's volume has traded in advancing issues than in declining issues. This indicates that market breadth is improving. It is improving, but it's still weak. So that's some of the pieces and components that make up the fear and greed index. You've also got the big one, which is market volatility, the SIBO Volatility Index, also known as the VIX, which right now is just a nudge above 17, and this is still in fear territory. So these are the things that are going on in the market. How are you doing? 844-305-7800. That's the number if you'd like to join us and talk about anything on your mind. Also, besides, we're going to talk here about strategies that you can do to save taxes for 2018, cutting your tax liabilities, your tax bill in 2018. Besides that, the other thing, too, is Roth IRA conversions. And I want to remind all of our listeners that tax rates at our currently, income tax rates in the U.S., are currently at all-time historical lows. And they will be this way for the next several years. And so how do you capitalize on that strategically? How do you take advantage of that? Well, by shifting money from your tax-deferred accounts, tax-deferred like traditional IRA, 401k, 403b, 457, these are all tax-deferred type of retirement accounts. You strategically shift money from tax-deferred to tax-free, tax advantage, which is Roth IRA. And you do that by doing Roth IRA conversions. But you got to be strategic about it. You can't just randomly pick a number and say, oh, I'm going to convert 10%, 20%, 30% of my tax-deferred accounts to Roth. There's got to be a plan behind it. And what I suggest even before doing this exercise is to have a written financial plan. That's where you begin. Once you have that plan, then you can begin doing, on a very deliberate manner, shifting money paying your taxes now and getting into the tax-free zone. I'm Ron DeLegge. This is the Index Investing Show. Coming up, more tax planning strategies, 2018.
The Index Investing Show with Ron DeLegge.
Have an investing question for Ron? Call 844-305-7800 or send your questions to @IndexShow on Twitter.
Okay, we're here, 844-305-7800. That's the number. @IndexShow is my Twitter handle if you'd like to join the conversation. How has 2018 treated you, your retirement portfolio, your investments? Do you feel secure about your future? Has October and the madness and the volatility and the veracity of the month that it was shaking you out of whatever investments that you owned? Or are you still hanging on? 844-305-7800 is the number. Have you made or built your investments on a rock-solid foundation? The rock-solid foundation should be a diversified mix of low-cost index funds, index ETFs, tracking the major asset classes. And there's 4 major asset classes that ETFs track: stocks, bonds, real estate, and commodities. That 5th major asset class is cash. So those are the 5 biggies. That's your foundation. That's your portfolio core. Have you made that your foundation? Because if you haven't, what's going to happen is when the real storm comes, the storm, the hurricane, the tornado, the first structures to be destroyed, the first structures to be demolished are the ones that are built on a weak foundation, the ones that have not been properly structured and built and constructed from the outset. And so I hope you're getting this analogy, because I don't want to see you, especially those of you nearing retirement or already in retirement, you cannot afford to suffer significant market losses at a very crucial time in your life. You just can't. Now, for younger folks, people that are still working in the workforce, still saving for retirement, they're at a different point of their investments because they can afford to take a major hit. Because in fact, taking a major hit's a wonderful thing because it allows them to acquire more shares at a lower price. But the difference is that people that are still investing and contributing and saving for retirement, the difference is they're in the accumulation phase. Somebody that is in the what we call deaccumulation phase cannot afford these types of risks. And so it's that much more important to build your portfolio on a rock-solid foundation. That's the first step. And beyond that, obviously have an adequate margin of safety, which is fundamental to sound and architecturally strong portfolios. So if you missed last week's program or any of the previous episodes, I encourage you to check them out. We talked extensively about margin of safety, what that means, how to make money in a market that is declining. So go to indexshow.com. You can also go to Apple, iTunes, listen to our program there, Google Play, as well as YouTube. We're pretty much everywhere. 844-305-7800 is the number. You're listening to the Index Investing Show. Coming up in the next segment, Silvia Jablonski at Direction Investments will be joining us. We're going to talk about a number of things. Among them, we're going to discuss thematic investments, this trend towards AI, also known as artificial intelligence, automation, robotics, how to capitalize on that. We're also going to talk about rising interest rates, how this has really been a spoiler for investors and people that were reaching for yield. They were going out on the yield curve a little too far, and especially going with those long-term bonds. For a long time, that trade worked, where you just piled into long-term bonds with long-term maturities because, well, Those were the ones paying the highest yield. That worked for a while. But when this trend of rising interest rates began, when the Fed started raising interest rates in a very deliberate manner, in a very consistent manner, which pretty much started in 2016 and has continued here into 2018, that trade of being in the absolute longest maturing bonds got destroyed. And it's been a great trade for certain ETFs, so we're going to talk about that with Silvia coming up during the next segment, so stay tuned for that. Looking at our Twitter feed, a couple of things that I need to share with you. Here's a retweet from StockCats. He said the Fed, that's the Federal Reserve, sees strong U.S. growth. Economic weakness is isolated to the other 95% of the planet. Well, my comment on that is the Fed is that one institution that sees everything and nothing simultaneously. Here's another retweet. This was from Helen Meisler. She she snapshot a picture of a Bloomberg terminal screen showing who the top holders of General Electric are. And number 3 is GE Retirement Savings. That's the third largest holder of General Electric stock. My comment on that is plaintiff lawyers are going to have a field day with this. They are just licking their chops on that. Investing retirement savings in GE, I'm sure they're going to find something wrong with that, especially when the stock's been cratering as it has. Here's another article link. This one to Bloomberg Markets. The Fed stands pat on interest rates ahead of an expected rate hike in December. It's a-coming. Market Watch. Why are so many people that are retired miserable? Well, when I say have a retirement plan, nailing the financial aspects of that plan is only part of it. You got to have a life plan, people. It's not just about the money. Well, it kind of is. It's a lot about the money, but it's also a lot about you and what you want to do in retirement. How are you going to spend your time? You're going to have fun? You're going to fill it up with activities? I think the media, I think the narrative of sitting on the beach in a beach chair watching the sunset while you drink whatever you're drinking, I think that's a misleading narrative about how retirement should be or what it's all about. Retirement today isn't really anything like that for the vast majority. Retirement today is much different. And so the point here is, what is your plan besides the money aspect? The reason so many people are miserable in retirement is because they have no life plan. They've got nothing to do with their time. They haven't filled it up with anything that's productive or meaningful. And so they've become lost souls. So come up with a plan. Have a hobby. Have something. Be interactive. Interact with others. Have a purpose. That's how you find meaning. That's how you find purpose in retirement and in life generally. Also, another thing on our Twitter feed at Index Show. Here, this was one of the more curious stories. A 69-year-old man who has a pension says that he has the body of a 45-year-old, and so he decided to take legal action to change his age. Yes, he's suing to change his age in order to improve his job prospects and also his luck with women on Tinder, an app. I guess it's a dating app. So my comment on that, well, wanting to be 25 years younger is a totally reasonable request. Unless, of course, you're 24. Then it's just creepy. So he's suing because he's got the body of a 45-year-old and he wants to change his age. Good luck with that. At Index Show is my Twitter handle. You can follow us there as well as our tweets, which are 24/7. And if you'd like to join the conversation, do so, again, at Index Show. Well, coming up next, Silvia Jablonski at Direction Investments will be with us. We're going to talk about some of the key investing trends, thematic trends, coming up next, right here on the Index Investing Show. Be here or be nowhere.
The Index Investing Show with Ron DeLegge.
The investment world is full of complex and expensive products. At Sector Spiders, we recognize the need for lower costs, more clarity, and greater focus. So we wrote a new chapter for today's investors. Sector Spider ETFs divide the S&P 500 into 10 distinct sectors. You can see exactly what you're investing in with full transparency. Each sector has the diversification of a mutual fund, the flexibility to tailor your investment strategy, the all-day tradability of a stock, and the tracking of an index. Sector Spider ETFs can be used to customize your portfolio allocations, overweight or underweight your sector exposure, and minimize single stock risk. Now it's time to turn the page to a clearer, more focused approach. Sector Spider ETFs, the next chapter in investing. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for a prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
Stop investing blindly. Listen to the Index Investing Show with Ron DeLegge every week on iTunes and indexshow.com. Learn how to grow and protect your money.
We're pleased to have with us Silvia Jablonski, Managing Director at Direction Investments, with $13.5 billion and change under management. Silvia, welcome to the program. Great to have you back.
Thank you so much for having me. Happy to be here.
Let's begin by talking about volatility in the market. You know, mainstream media typically portrays this as something negative, especially when volatility is rising. But higher volatility can lead to market dislocations, and therein lies the opportunity. Do you think investors should start reevaluating their opinion or view of volatility and maybe start looking at it as an opportunity rather than a foe?
That's a great point. And, you know, just looking through the past month of, you know, what happened in the major indices, if you were an investor, you had, you know, it probably at first glance almost nowhere to go. The S&P fell, you know, over 6%, NASDAQ fell over 8%, the Dow Jones close to 5%, MSCI, emerging and developed markets were down, crude fell, gold fell, you know, so what didn't fall? And the answer is pretty much consumer staples and utilities, the two, you know, sort of main defensive sectors looked okay last month. But what a lot of investors miss out on, and you know, what we try to do here at our firm is to kind of highlight is that when markets are volatile and when markets are you know, sort of downward and trending downward for a short period of time, which in October is what we saw, you know, sort of a little bit of both conditions, depending on the sector. It's a great time to capitalize on potentially looking for opportunistic bear trades to generate some alpha. So, you know, last month, for example, tech was down for several days in a row, and investors that looked at 3 beta tech bear funds did quite well. You know, investors that looked to sectors like healthcare, which is, you know, sort of lumped into that defensive type of sector, you know, sort of great earnings, generally not impacted by what was going on, especially towards the end of the month. You know, they definitely found some opportunity there. You know, emerging developed markets in China were, particularly in the beginning of the month, just, you know, sort of straight down. And I think, you know, investors that you know, understand, or are tactical traders and understand the you know, compounding and rebalance mechanism of a levered ETF can really benefit if they're tactical both on the way down as they are on the way up.
Silvia Jablonski with us. She's Managing Director at Direction Investments. Go to directioninvestments.com. That's DIREXION, investments.com. You can also check out their lineup of lightly leveraged bull ETFs at portfolioplusetfs.com. One of the most exciting thematic investments is the trend toward AI, automation, and robotics. AI, of course, known as artificial intelligence. We're seeing this, though, with the invention of drones. Driverless cars are also on the horizon, and other applications. So at Direction, you guys recently introduced an ETF linked to this very important investment theme. It's called the Direction Daily Robotics and Artificial Intelligence and Automation Index Bull 3X shares. That's ticker symbol UBOT. Tell us more.
Sure. It's a super exciting sector, actually. And when, I'm out there talking to clients, I often hear, them asking things like, if you look at our 3-beta tech ETF, for example, prior to October, it was up over 5,000% on the last decade. The Apples, Microsofts, and, Alphabets, Amazons of the world before they moved to communications, and investors are saying, like, okay, great, well, that's over now. So where's the next, where's the next potential trend? And you kind of hit the nail on the head with the introduction of robotics. UBOT is our ETF, and basically it seeks the daily performance of AI, automation, global robotics. So this is a super interesting sector. Robotics touches so many parts of both our lives and everything from, manufacturing to medical fields to automobiles. So, you have names like Fanuc in that index, which basically automate factory equipment. So in places like Japan, where you have an aging population, you sort of look at that industry and think, like, how will this hold up? We don't have enough young workers sort of seeking those jobs, and the aging population is leading to sort of enough of a mass exodus where it's concerning in their factories and plants. And now they've essentially got robots doing a lot of that work. You have the growth of AI and driverless cars. You have the whole gaming industry. You have Da Vinci robots. Essentially guided assisted robotics in medical surgeries to create a situation where major procedures can become less invasive than they have in the past. And these names really give consumers and investors the opportunity to invest in sectors that benefit from adoption and utilization of robotics and AI, and automated inventory management, production and supplies. And it's definitely, people have sort of coined it the millennial trade. I wouldn't necessarily call it the millennial trade. It's just sort of the automation of the various industries and sectors of our lives. So there could be some potential growth in that space, and UBOT's a great way to access it.
If you're just joining us, you're listening to the Index Investing Show. Pleased to be talking with Silvia Jablonski at Direction Investments. Now, rising interest rates have spoiled the party for investors who reached for yield by buying long-term U.S. Treasuries. So how can traders exploit what's happening right now with falling bond prices?
Yeah, Ron, it's a great question, and probably one of the most, if not the most relevant question in the market right now is the concentration on rates. And what we tell investors is, again, what we were talking about at the beginning of top of the hour, is that volatility and pullbacks in the market are somewhat scary, but they also represent potential investment opportunities for advisors. So in the case of interest rate hikes, you have bond prices falling. So what do you do with that? Number one, if you're a wealth manager, or if you're an investor that has a significant amount of duration risk in your portfolio, meaning that let's say you have a 30-year treasury and we have 1% worth of rate hikes, that position, that notional value would fall somewhere around 17% just based on the duration of a 30-year. So what we have at Direction are two inverse funds that one is TYBS, which is an inverse fund meant for buy and hold investors. And the second is TMV, which is a -3 beta inverse treasury ETF. So the -1 beta has a duration of -17. So essentially you use that to hedge out your risk, or you simply use that to take an inverse view on, as interest rates rise, bond prices will fall. The 3 beta ETF is more powerful. It's essentially a -51 duration because it's a 3 beta fund. So again, you can use it two ways. You can take a small percentage of the ETF, say 5 to 10%, you can cut down your duration risk. Or if you're just an investor looking to express a view that interest rates will rise and bond prices will fall, TMV is a great way to capture some opportunistic alpha on that. And that's an ETF, by the way, that year to date has been up to close to 20% because the Fed actually has been engaging in interest rate hikes, and we expect that to continue into next year. So it's a great opportunity for investors to take a look at.
Well, thank you, Silvia, for taking the time to join us. Again, you just heard from Silvia Jablonski, Managing Director at Direction Investments. I want you to check out their website. As I mentioned or alluded to in that interview, they've got some great resources for ETF investors, directioninvestments.com. That's spelled DIREXION, investments.com. And when you hit that webpage, there is at the very top a navigation bar titled Education. You click on that, and then you'll see a video series titled Understanding Leveraged and Inverse ETFs. So I want you to check that out. I'm also going to link to that on my Twitter feed, which is at Index Show. That's where you find me on Twitter. And then also, for those of you interested in leveraged bullish ETFs, but with less leverage, check out PortfolioPlusETFs.com, which is another lineup of exchange-traded funds offered by Direction. Also, by way of reminder, if you ever miss our regular radio broadcast for whatever reason, we archive every single broadcast up at our website, indexshow.com. You can also find us at iTunes, Apple iTunes. Just search under the Index Investing Show. I'm Ron DeLegge. This is the Index Investing Show, and I'll be right back after this short break.
The Index Investing Show with Ron DeLegge.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
All right, welcome back from the break. 844-305-7800 is the number. And coming off a great interview there with Silvia Jablonski at Direction Investments. Talked about a lot of good things in that interview. We gave you some strategies for capitalizing on rising interest rates. You don't have to sit on the sidelines and watch your bond portfolio melt away. There are hedging techniques. There are strategies to capitalize on that. We gave you a couple of ETF ticker symbols that are designed to increase in value when bond prices fall. One of those, TYBS, TYB like boy, S, that's the Direction 20-plus year Treasury Bear 1X shares. That's, I would say, a good ETF to put on your radar for hedging against any further declines in long-term U.S. Treasuries. And if you want to be a little bit more aggressive with that trade, you can up the ante by using leverage. Ticker symbol TMV as in Victor, TMV, which aims for the same exposure, inverse exposure to long-term U.S. Treasuries, but with triple daily leverage. TMV, and that particular ETF, one of the best performers thus far in 2018. Now, we wanted to talk about, on today's program, strategies for reducing your 2018 tax bill. And I can't, when I go back to thinking about taxes and how complex of a subject it really is, I think about what humorist and I think it was an actor too, Will Rogers, once quipped. He said that the only difference between death and taxes is that death does not get worse every time Congress meets. And so I think that's a real testament to how complex taxes can be. But as 2018 heads towards its grand finale, now is the time to look at ways to reduce the tax pinch. And you can do this by just a few year-end tax-savvy strategies. So the first strategy is to harvest some of your losses. So U.S. indexes for stocks, for the most part, are still modestly up, yet many individual stocks are not. And so I've put together a list of candidates. We've talked about a few of them on the show, but you've got a growing list of candidates, stocks that are negative, that would be great tax loss selling candidates. These are companies that have negative 2018 performance. Maybe they might even have positive performance, but perhaps you bought them at the high and now they're down, right? If you bought them, let's say in the summer or in September, and now they're down, well, that may be a good tax loss harvesting candidate. And so as you move into November, which we're in, and as we move into December, which we'll be in, you should start realizing some of those losses to offset any gains inside your taxable portfolio. I would say the mother of candidates for 2018 would be General Electric, GE. This is the shining example of what tax loss selling is all about. It's the perfect tax loss selling candidate. Since the start of 2018, GE has fallen more than 50%. Meanwhile, its peer ETF, ticker symbol XLI, has managed a modest decline, much less than GE, a modest decline of around 3%. By the way, XLI owns GE along with a whole bunch of other industrial stocks. So you take a look at this as a opportunity to unload GE, realize some losses, and then redeploy the sale proceeds into XLI so that you avoid what's called the IRS 30-day wash sale rule. So it defines a wash sale as one that occurs when a person sells a security at a loss, and then within 30 days before or after the sale, they buy a nearly identical investment. So we don't want to buy a nearly identical investment. If we're selling at it at a loss, we got to replace it with something. And so using ETFs that are in the same industry group or sector is a great replacement strategy for getting rid of your losers, still maintaining exposure to that same area or group. And then if you want to rebuy it after that 30-day period has gone and passed, you can do that without running afoul of that IRS rule. So look at your portfolio, your taxable account, look at the stocks, look at the mutual funds that have lost you money in 2018 and start considering harvesting some of those losses. And of course, like I said, you could use ETFs as great replacements for some of those losing positions. The other thing, too, is that for those of us with taxable accounts, taxable money, the majority of mutual funds, if we own any mutual funds in those taxable accounts, the majority of mutual funds pay or distribute their capital gains typically in the final 2 months of each year. And so for investors who own mutual funds in a taxable account, making new deposits into a mutual fund right before a year-end distribution is a big no-no. And it's a mistake that I see over and over again. I mean, it happens every single year. And so rather than attempting to estimate what a mutual fund's capital gain distribution is going to be for 2018, a better strategy, I think, could be to switch part or all of your holdings away from a potential tax bomb and go into a tax-friendly ETF. And so to locate a qualified ETF substitute, simply identify the asset class or the investment category of the fund that you're replacing. And from there, you're going to find a bountiful menu of viable ETF choices. You can use resources like xtf.com or morningstar.com to help you research funds that are in the same general area or category and look at them as better, more tax-friendly type of investments. This is for your taxable account. So in summary, it's time right now to take a look at minimizing your 2018 tax bill. You're not going to wait until the very last minute to do this. Now is the time to do this. And it's important to remember, too, that while ETFs are tax-friendly, they do not avoid taxation on dividends or income. So it's the ETF structure, and we don't have time to get into it today, but it's the ETF structure. It's a superior legal structure that allows it to be tax efficient and to be shareholder friendly. So that's what you need to remember. 844-305-7800 is the number. This is the Index Investing Show. We're here. At Index Show is where you can follow me 24/7. You can also check out our YouTube page as well as Google Play and indexshow.com. And last week's show, we talked about some of Ron's online classes. Have you become a student yet? If not, go to indexshow.com and enroll. Wanted to mention energy stocks real quick here. I mentioned them briefly earlier, and it's been a great trading opportunity for bears. If you're bearish on energy stocks, if you're bearish on oil, over the past 3 months, ETFs that aim for opposite performance to the energy sector and to oil stocks have been great performers. Check out ticker symbol ERY, which is ahead by 22% over the past 3 months. DRIP, ticker symbol DRIP, ahead by 27%. And those ETFs aim for opposite or inverse exposure to energy stocks along with oil and gas stocks. So that's been a great trade. And energy stocks over the past 3 months have not been good performers. One of the weakest performing sectors within the S&P 500. And that particular area continues to struggle. Energy stocks as a group, XLE, since the beginning of the year, are down about 3%. So that's your wrap. Be sure to join us again next week, same time, same station. We'll be here talking the birds and the bees of successful investing. And until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producer.